Well, for some perspective on the U.S. markets, let's bring in Jim Bianco. He's president of Bianco Research. He's joining us from Chicago. Jim, great to have you here on Surveillance Midday. The market trade today, we've had a bunch of down days here in a row, a lot of negative sentiment in the markets. What do you make of today's trade specifically?
Well, I did think we kind of hit a short-term oversold in the market. We had been down so many consecutive days. I'm not surprised that the market has rallied, but I don't think it's changed the overall trend of the market. It still seems to be either in a sideways to lower pattern right now.
All right. You've got a really cool index, and I want to bring it up for everybody because I found it interesting in your research. It's the Citibank Economic Surprise Index. Today we were surprised by some upbeat trade information, some trade data. Talk to us, though, about the Citibank Economic Surprise Index. What does it tell you?
Basically, what it measures is it measures the economic releases relative to the Bloomberg median estimate. So if a number comes in below estimate, the index will show it as a decline. If it comes in above estimate, it'll show it as an advance. And what we find is if we look at 2011 and we find from March forward, and especially since around late April, this index has collapsed. It means that every economic number that we've seen for the last 5 or 6 weeks seems to come in worse than what we expect. So it doesn't mean recession. It doesn't mean that the economy is going down. It means that economists are fundamentally too optimistic about what we've actually been seeing. Now, they try to explain that away by saying it was bad weather in the spring or it was the earthquake in Japan. But everybody knew that, and everybody factored that into their forecast, and the numbers have still disappointed, even though we all knew that those were coming.
You know, Jim, that's a great point. We're going to talk to Carolyn Baum later on. She's a Bloomberg columnist, and, you know, kind of pokes fun at, I think, all the folks coming out saying, oh, look at all these headwinds all of a sudden. I mean, these headwinds are not just all of a sudden. They've been out there.
Yeah, they've been out there for a while. This economic index actually peaked in March, and it's been unfolding over a period of a long period of time. And this is why I think the debate about QE3 is coming up and won't go away. Even though a lot of the Fed officials, Bernanke himself a few days ago, and a lot of Fed watchers that are closely connected with the Fed say there won't be QE3, there won't be QE3. Market participants look at things like this economic index and go, if this economy continues to do like this for the next few more months, the Fed's going to be compelled to have to react to it. They're not going to sit by and just let this happen.
All right, well, don't give away all your QE stuff because we're going to talk about that a little bit more with a friend of yours in the next block. Talk to me, though, a little bit about some of the economic news today and what it means for the market environment. We've got, what, jobless claims. They're above 400,000 again. It's the 9th consecutive week that we've seen this. We know the labor market's ugly. We knew that in Friday's jobs report. But again, that reminds us, if people aren't getting jobs, they're not out there spending, obviously key to the economy and ultimately important to the market environment.
That's right. The jobs rise that we've seen right now over the last, as you mentioned, 9 weeks is the largest rise we've seen in initial claims since the recession ended in June of 2009. Even bigger than what we saw last summer when we were all talking about a double-dip recession. And couple that with the payroll number, and it is showing that job hirings are going to slow dramatically. Now, it doesn't mean we're going to see negative payroll numbers, but given the population growth and everything else, it's going to be very difficult to get the unemployment rate much below the 9% level that it is at right now. And that's going to prove to be very frustrating for a lot of people that are hoping that the economy is going to do a little better and have better job creation than we've seen.
Jim, what do you make of the trade data today? It was certainly a surprise here, narrowing in April. We got a plunge in auto and oil imports combined with record exports. Should we be optimistic as we're seeing it play out in the markets today?
Unfortunately, I'm not that bullish about what we saw at the trade numbers. As you mentioned, the plunge in autos. This one, at least, we did see coming. It was associated with the earthquake in Japan. A lot of auto production was taking place in the area that was affected, both by the nuclear meltdown and we should suspect to see these numbers rebound. And when they do, we expect to see the trade deficit go back up. So I think it's more of a statistical quirk than any kind of thing that's meaningful.
So, Jim, you know, I'm just looking at some headlines crossing right now from Janet Yellen over at the Fed. She says the U.S. housing to undergo a drawn-out recovery, saying the housing market recovery inhibited by tight credit. No quick or easy solutions for the housing market. None of this is a surprise. Can we ignore housing and yet get back to some kind of recovery here in the economy?
Ignore housing, no. I mean, we can have a bit of a recovery, and we've had a bit of a recovery. The recession ended June of '09. But if we're going to have some kind of a major move forward in the economy, housing has to come along with it. 6.9 million jobs have been lost since the recession started in December of 07. 2.5 million of those 6.9 million have come out of the real estate area. And the biggest area there has been in construction. And especially for a lot of low-skilled people that have been looking for jobs for the last several months, those people that have been unemployed for more than 26 weeks, construction has been a big place where they found jobs. Well, we need housing to come back to get those construction jobs back. So it limits what we can do in terms of an economic recovery if we don't have housing move forward.
Hey, let's bring in Sassan Ghahramani. He's president and CEO of SGH Macro Advisors to join this conversation with Jim Bianco. Sas, great to have you here in Surveillance Midday.
Thank you, Carol. Nice to be here.
You heard Jim just talking about housing, and that really kind of limits any move ahead in the economy and really for everything going forward. You agree with that?
Well, I think there's two issues right now for the economy, and one is an issue of overhang, and the other is an issue of uncertainty. And if you look at the issues of overhang, I'd put housing certainly in that category, as well as the debt crisis. And there's not a lot that we can do.
The European debt crisis.
Yes,
or
and also the U.S. debt
crisis.
I'd add to that. There's not a lot we can do about housing. The part about uncertainty and expectations and so on of the future, I think that can be improved and resolved over time with a little help from policymakers, both here and in Europe.
Hey, you know, something that caught my attention in reading through your note, and this is something that you said was very little noticed in the minutes from the FOMC back in April, and you point out how the FOMC wrote that they believe that the level of uncertainty associated with their projections for economic activity and inflation were greater than the average that had prevailed over the past 20 years. Yeah. They're not talking like, well, you know, we haven't been this uncertain in about a year or two. Yeah. 20 years, you say ouch, for good reason.
Yeah, no, that's right. That's right. And the level of uncertainty is unprecedented. On the inflation side, there's a lot of uncertainty as well, and it's not just some of the growth risks right now. And I think that's where this whole QE3 debate comes in right now, and why things are different now than they were this time, you know, last year when they were debating QE2, is because they acknowledge that there is some uncertainty right now on the inflation side, and, you know, headline coming back to court. They talk about this being transitory and so on, but there is an element of doubt there right now.
I mean, Jim, no doubt about it that there's an element of doubt. What does that mean, though, for QE3? There's so much debate out there. Mr. Bernanke didn't mention it, certainly in his speech this week. Do you think there's a good chance that we get more stimulus from the Federal Reserve, or we can't afford to?
Well, all stimulus by the Federal Reserve is going to be data dependent. The Fed is going to do like the rest of us. I think they're going to watch the data, and if the economy weakens more, they will respond. And I think that Sass is exactly right, that their uncertainty is so high that they can't say with any confidence, don't worry, the economy won't get any worse from here, so QE3 is off the table. If this is the worst we get right now, there won't be QE3. But if it continues to get worse, then QE3 becomes more and more a possibility.
What do you think, Sass? Because you kind of write that you think you don't see any indications anytime soon or anytime near on the horizon.
Yeah, and I'm familiar with Jim's work. You know, we are affiliated both with the same company. Do you want to say he's wrong?
Do you want to say Jim's wrong?
And I will say that that's one of the things, Jim, that I will bet you a New York steak against the Chicago pizza on QE3. I understand what you're saying. Under the present circumstance, there's no chance of QE3. But I do think that the bar is a lot higher right now, and I don't think it's going to be questioned.
Which bar is much
higher? The
bar
to the Fed embarking on QE3. I take them at their word when they say that, when Bernanke and other of the leadership of the Fed say that the bar is high right now. It's not a question of, you know, as far as the stock market dropping another 10–15% or something like that, I don't think that put is really there right now. Wait.
I'm going to break in because we've got a really cool chart that I keep trotting out, and this is from Doug Cliggott over at Credit Suisse, and this looks at the size of the Fed's balance sheet and compares it with the S&P 500, and there it is for everybody. I mean, there is a significant correlation between the size of the Fed's balance sheet and what we're seeing in terms of equity gains here. So you buy it, or you think you don't buy the data there?
Well, no, there's no question that there's a correlation there. But the question is, going forward, is there a chance that the Fed increases the balance sheet, or are we at a question of how long do they maintain the balance sheet at this level, and when do they start reducing the balance sheet?
But if the market starts to go back, you don't think the Fed's going to get a little nervous here?
Well, they'll get nervous. But the trigger for them is going to be, I think, unemployment is going to be It has to break. It has to reverse this trend, break above 10%. I think you're going to have to see things like that rather than a 5, 10, even 15% drop in the stock market. Nobody likes that, obviously.
Right.
But I don't think that's going to be something that brings these guys back out again. Say, you know, hey, let's start talking about more stimulus.
Jim, what do you think? If the market, I mean, we've already seen, you know, today's a better day, but we've been down for what, 5 weeks here on the equity trade. I mean, if the market significantly goes into a real correction, a 10% correction, as some keep telling me, will the Fed get nervous enough to act again and talk about QE3?
Well, this is where I differ a little from Sassan. I will take him up on that bet that if the market corrects, yes, I do think so. I would emphasize, like, if this is the worst we see, you won't get QE3. But if things worsen, and I suspect they will, you could possibly see the Fed step up and act. I think if anything else, it would be more political than it would be economic. As Sass mentioned, he's absolutely right. They look a lot at the unemployment rate. And if we were to see a 10% unemployment rate, the Fed would act. But the Fed has yet to make a compelling case as to why monetary policy can bring the unemployment rate down. They've been trying for 2 years or so. They have made a compelling case that monetary policy QEs can push up asset prices and maybe try and create a wealth effect. Now, maybe we haven't had one yet, but at least they know they can do that. They can help prop up asset prices, which is what your chart showed. So if things get worse, I do think I'll win that bet.
The bet has been made. You know, Ben Bernanke did say this week monetary policy cannot be a panacea, kind of acknowledging that monetary stimulus has its limits. So is he kind of laying the groundwork, Sass, in our view, to kind of get ready, everybody, it really is going to end?
Yeah, I think so. I think very much so. I mean, at this point, the most important thing for the Fed is the removal, and for the economy, I think things that are within our control or within human control are removal of some of these uncertainties that are out there on the policy horizon. There's a lot of issues with bank regulation right now that are weighing on the stock market, with, you know, with tax policy, again, with the whole debt ceiling. And
quite a laundry list.
Yeah, quite a laundry list. And I think that's one of the things that they're very focused on, and I think that we should be focused on as well.
There is definitely a disconnect between what's going on in the U.S. We heard from Ben Bernanke, cautionary words, doesn't look like we're going to see any kind of rate increases for some time. Yet Jean-Claude Trichet hinted at something else. I want to get your thoughts on it, but let's first listen to the ECB president.
We are not in favor of restructuring, haircuts, and so forth. We exclude all concepts which would not be purely voluntary without any elements of compulsion.
All right, I messed you up because I actually wanted to hear Jean-Claude Trichet talking on
it's a good
rates.
Clip too, though.
It is a good clip, and let's talk about that. But I'm messing my guys up a little bit today. He did talk about maybe hinting that we could see higher rates. Is that going to provide some problems for the global economy, or the disconnect between what's going on in Europe and in the United States?
I don't think so. You know, the market is already factoring in a rate hike in July, and that's what he essentially signaled.
So the markets know about this.
And so the markets know about this. The markets have priced it in, and the transmission mechanism of higher interest rates in Europe is a little different than it is in the U.S. And so it's not quite as direct, and it's not quite as blunt a mechanism. So I don't buy that. I don't think it really.
You're not worried about it?
No, not really.
All right, let's talk about what you did find interesting from Jean-Claude Trichet, where he said they're not in favor of restructuring, they're not in favor of haircuts or so forth.
Yeah.
What does that mean then for Great debt?
You know, there's definitely a difference of opinion here between the ECB and EU, and German Finance Minister Schäuble has been very vocal.
He can say this then, Jean-Claude Trichet.
Very vocal about this. Yeah, I mean, they've been. He's repeating a position that they've had. The interesting thing is that he's reiterating it. He's reiterating it strongly, and he's repeating it right after this very public letter that the German finance minister wrote, essentially saying we want to revisit this whole reprofiling, and it's a question of, you know, how much burden sharing there is on the private sector or not. And so the ECB is holding to their guns here, and there is a conflict here.
Listen, I do want to point out, too, you know, let's just talk about Greek a little bit more closely. The FT out actually with an op-ed today and talking about how, you know, even if they deal with kind of their financial problems. There's so much more there. They say Greece has wasted 2 years. It could now face a bank crisis as household confidence in its banks dwindles, while unemployment will hover above 20% this year. The biggest problem is that Europe will gradually lose patience. They talk a lot, too, about cronyism and the political system and how difficult it is. It's a bad system. It creates lots of entitlements, and it got us to the problem they are today. If you don't change that system, it doesn't matter whether you get a restructuring or whatever.
Yeah. No, that's right. And I think that's why the EU, and it's not just the ECB, but the EU policymakers, who are generally have been more friendly towards Greece, have really kind of turned their focus towards asset sales. And they're like, just show me the cash. We know that you're doing your structural reforms. They're obviously not going to let up on that. But to the extent that you can kind of squeeze blood from a stone, you know, you're going to raise more money from greater tax receipts in a country that's already in arrears. Sell the assets, give us the cash, show us the money right now.
We'll see what they end up doing.
That's
Thank you so much. Sassan Ghahramani.